Hi, I'm Jennifer Chino, Senior Vice President at TTR Sotheby's International Realty and Team Lead at Staley Thompson Homes. If you are excited about the potential of renting out your home that has a souvenir rate, aka a super low interest rate, and you are thinking about how does that work if I want to purchase a new home, you're in luck. I recently met with Chris Grizzell at NFM Lending, and we discussed what the process is and how you can take advantage of becoming a landlord, renting out your current property, and how does that work when you are looking to purchase a new home. We also have some tips for new landlords that you might not have thought of, and I'm looking forward to sharing it all with you. Let's get started. I am Jennifer Chino, Senior Vice President at TTR Sotheby's International Realty, Team Lead of Staley Thompson Homes, and today I'm talking with Chris Grizzell at NFM Lending.
Hi, thanks, Jennifer. I'm Chris Grizzell, Branch Manager at NFM Lending here in Annapolis, Maryland. We are licensed in 49 of the 50 states here at NFM, so we can help your clients throughout the country. I've been in the business lending since 2008 and real estate since 1999. Wow, that makes me feel old.
So today I wanted to set aside some time and go over a couple of topics that we found recently that have been sort of in the forefront of everyone's minds. The first one is all of the homeowners that are so enticed by their current interest rate that they are toying with the idea of becoming a landlord. So I want you to talk a little bit about that and what that looks like from the mortgage perspective.
Sure, perfect. I actually did that myself. I didn't want to give up a low rate. I call them a souvenir rate, the COVID interest rates that we'll likely never see again. So I looked at it and said, do I want to give up this rate on this loan that I have, because I'll probably never see that again, and become a landlord, generate some positive cash flow, and then move to a larger home. So, the pros of that are that, building wealth through real estate, they don't make any more property, right? Any more real estate. So that's, a supply issue. And that's what we're seeing right now, why prices are so high. I get about $700 a month of positive cash flow, which is nice. I actually apply that towards my mortgage to increase the equity that I have in there. And then someday I'll sell it. So, it's kind of annoying sometimes getting the calls that I need to fix something or have something fixed. And when I decide that I've had enough, then I'll certainly sell the property. But most importantly is, how does one qualify carrying two mortgages? Because, just like a car loan or a student loan, mortgages are considered debts and monthly liabilities that we have to account for. So what we typically do is we have an appraiser go out to the home that you're moving out of, but retaining. And the appraiser, just like they'll appraise your new home and say it's worth a certain amount of money, hopefully what the contract says, the appraiser will say, you can rent this home for X amount a month. And we use that rental income to offset that debt that you have on your credit report. So rarely does it offset the whole thing, but let's say you have, for easy round numbers, a $2,000 monthly payment on your current mortgage. And the appraiser goes out and says, Chris, you can rent your home for $2,000 a month. Exactly. So we take 75% of that, so we can offset the $2,000 with $1,750. So then it counts as a $250 debt on your credit report rather than $2,000. Okay, so you don't actually have to have someone lined up and living there before you move. You don't have to have a lease in place. You don't have to have a security deposit for most programs. So we just have the appraiser go out there and do that. Now, for your budget, you'll certainly want to have a renter lined up right away, which of course you can help with, right, Jen?
Always. And that has been happening more than you know recently, which is why we're having this conversation.
For sure.
So when it comes to someone that is going down the landlord route and keeping that interest rate and moving into a new home, are there any sort of things that might not be obvious that they need to consider when it comes to your end with the mortgage?
Well, certainly, we need to be pre-approved and work this out well in advance, because, getting a call perfect example. Last Friday evening, I had the same scenario happen, and and we have to create these assumptions and be very conservative with these assumptions of what your departing home might rent for. Because if we're going to go under contract, we should really have a pretty good idea before we do that, right? I mean, there's two sides to this transaction, and we need both parties to be happy and get to the finish line. So certainly planning up front, asking you, Jennifer, what do you think my current home could rent for? You pull some comps, and we kind of take an average to be safe with that. So we don't want to stretch it, to the last penny that we qualify for. But typically we don't need to, because the offsetting that current mortgage with an estimated future rent is enough to handle that. Personally, I like to see people have a couple months reserves, extra cash in the bank somewhere for that rental property, because now you're going to own two properties. And, if, your AC goes up in one house, that's one thing, but if it goes up in two, that's another. So we need to account for that. And you've helped, me with, insurance programs and things for my rental property as well, that has helped offset some of those costs. So another common question I get is about rental income. So from a tax perspective, let's say, I claim, or I get $700 a month positive cash flow. That's only almost $10,000. But that's all real money, because when you own an investment property, real estate, real property, you depreciate it, and the government requires you to. So it's not even an option. And due to that depreciation, which is a paper, line item transaction, you actually create a loss on your tax returns, and therefore you actually bring home more of your real paycheck at the end of the year. And I always tell people, you're not going to really feel it right now. You might be a little bit skeptical, but when you do your tax returns next April, you'll call me and be like, "You're right, I did get more money back."
We always like that. You're right. One of the things when people are becoming landlords that I tell them ahead of time, like the house that we purchased it with the intent of it being a rental. I think one of the problems with people turning their homes into rentals is when they purchased it, they didn't purchase it with the mindset of a landlord or an investor. One of the worst things we ever did was one of the first house that we purchased that we turned into a rental. I did the bathroom. We remodeled it with all marble. That was the silliest thing I could have ever done for a rental. So I do think that when people are determining whether or not they want to keep their home, they bought it as their primary residence. A lot of times I have clients that have a very hard time with other people in their home that don't take care of it like they do. It's their home. They had memories. Maybe they brought their children home in them, and then they see how other people don't take care of it like they did. And that can be a bit of a barrier when it comes to, having it or turning it into an investment when it wasn't an investment to begin with. The other thing is there might not be as durable fixtures or finishes in the home like you would if you were purchasing something for a rental. So that's something that I've also been counseling people on when they are deciding to sort of go this route and becoming landlords, most of them for the first time.
Yeah, for sure. There's certainly an emotional aspect to owning your home and raising your family and then letting someone else live there, right? So yes, it's got to be strictly mathematical once you decide to make that move. So then you're going to have a lower interest rate on your rental property than you will on your new primary residence. You're going to choke on the new interest rate because you just can't believe that happened. And that's my life every day. I feel like I need to apologize for current rates, but they don't ask me to set them. So it's important, I would say, to understand that interest rates and real estate is a cycle. It's been a cycle for 70 years. I think that history is going to repeat itself. We just don't know exactly when. I kind of thought that it would be by now that we'd see rates come down. But today we saw the 10-year Treasury hit over 5%, which hasn't happened since 2007, right? And that's actually when I got into the mortgage business. And then what happened? And then rates went down and the entire world refinances and improves their rates. So what does that mean? I mean, likely the people that we're talking about here have lived in their home and then refinanced it. But a refinance is a very inexpensive transaction. I mean, it's like $2,000 and you don't write a check for it. You roll it into your loan. Most people do that is. And then you improve the terms of your loan. And sometimes people say, well, I've had it for 2 years. I don't want to start over at 30. Mm-hmm. Well, that's okay. We'll just make it a 28-year amortization and tell you what that payment is.
Now, with that, is there used to be a calculation that you would do and say, okay, it makes sense if you're going to be in your house for 5 years or whatever. Is there some sort of calculation to determine if it makes sense to refinance or just stick with the current mortgage rate?
Right. So like if you ask like our parents, they'd say, do you need to be at least 1% lower? But that's not the case. Okay. Most people that purchased in 22 and 23 will refinance probably a few times. So what we do is we say, okay, the cost is this, the interest savings is this, the payment savings is this, how long is it going to take to recoup that? And if it's a short enough period of time, then it just makes sense. The other thing that we can do is the lender can give you a credit for closing costs to make the transaction almost a zero time frame break even. So like, if it takes me 2 months to break even or 3 months on the small expense that was incurred to refinance, why would I not do that? And then in the next year, let's say they're even lower. It's not like I would look back and go, man, I wish I would have kept that 8% for another year, But, that's a common question. We every time we do a refinance, we have to figure out the break-even analysis. When we buy a home, it's urgency. It's time sensitive. We cannot miss a beat because we've got a legally binding contract. When we have a refinance, it's more of a financial plan. It's like, if this happens, what are we gonna, how are we gonna handle that in the future? So. That's the way we handle it here with the refi. And sometimes people will go refinance and say, but I moved into this house and we didn't have, we were very payment sensitive at 8%, but now we want some cash because we want to fix up the basement or redo the. So we figure out, well, we can skip 2 payments. You get your escrow back for your taxes and insurance. We can pull some cash out, and then your payment's still lower than what you have today. So there's a ton of different conversations that we have when that time comes.
It's interesting. That's a good point, because I feel like people don't, and maybe it's just the industry that I find myself sort of coming up against a lot. People don't realize that we're consultants. Just because you're having a conversation with us does not mean that you need to buy a house right away or you need to get a mortgage. There's a consultation that can be had prior to you doing anything. And just because you're opening up the conversation does not mean that there's anything that needs to happen instantaneously. I always say you can't bring me in too soon when it comes to selling your home, because there may be things with timing, there may be things that you need to do, there may be things that you don't need to do, but let's have a consultation, a conversation about it. And I think it's the same thing in your world, where just because they're having a conversation with you doesn't mean that you're going to pull their credit and all of a sudden everything's going to go from 0 to 60. And I think people really need to understand that there is a consultative approach to both the real estate portion and the mortgage portion, and it can really help them financially in both cases.
For sure. I mean, the first conversation we have with anyone should be a 15-20 minute get to know each other. What are your goals? What are your plans? And then I send some feedback to say, does this look like this would fit your budget? And then they, chew on it for a couple of days and come back to me and say, how do I get a little bit lower payment? Or how do I put less cash down? Or, what is this mortgage going to look like when rates come down to 6? I mean, that's all like things we have to think about. Because once you're in, you own the property and you're responsible for the mortgage, taxes, insurance, all of that. So yes, this needs to be a plan well thought out. And then sometimes we don't hear from people for a year, and then they say, I found the house, and I have to go, who is that Jennifer person? And then go find them, But yeah, certainly there's a consultative approach to this. It's stressful for my end when we get the call on Friday evening saying I found a house and their offers are due by noon on Saturday. I mean, because that means like, the pressure's on, versus if I would have talked to you 60 days ago, I would have already had your loan go through underwriting and I could tell the seller, this is already approved. This is a commitment letter. We just need a contract and an appraisal. That's a totally different scenario.
It's interesting too, because when people, they start the process a lot of times with me instead of with a lender, and their question is always about the rates. And I always tell them it's not just about the rates. It is very much a customized approach based on you and your financial terms. So it's so interesting how people come into it. And I don't know if it was, a generational thing and that's how people are brought up, but there is a lack of understanding that it's literally not just about the rate. There's so many other components to it versus just the rate. That's why I say have a conversation and don't be afraid to have that consultation ahead of time, because you may be surprised with what fits your needs better than what you came into this process assuming.
Right, for sure. I mean, as a loan officer, when we show up at a network meeting or a neighborhood barbecue, it's like, hey, Chris, how are rates? It's like, that's not all I do, right? Google it, but yeah, I mean, the rate determines our payment for sure. And a large portion of our monthly payment at the beginning of a mortgage is interest. And, I provide debt, and debt is my career, and that's how I, earn an income, but I am debt averse. I would prefer to have lower debt personally than higher debt. So, making those extra payments, if it's possible, while rates are higher, is far more impactful than, when rates come down, to make an extra payment on your mortgage. And then, you always want to pay off the consumer debt first, right? Like, if someone's buying a home, they might put less money down, but pay off that credit card. I think the average credit card rate right now, Jennifer, is 24%. I mean, people are carrying balances on that, but have some savings in the bank. Like, you should pay that off and put a little bit less down on your house, right? Which always leads to well, I don't have 20% to put down. Most people only need about 5% to put down to purchase a home. It would be far more financially beneficial to pay off that credit card and put a little bit less down on your house than have to put 10 or 20% down, whatever's in your mind. That's the golden number to get the mortgage. Conventional mortgage loan balance, is going to about 750,000 in our area. And then in other counties, it's considered a high cost county. It's like almost $1 million before we go into jumbo. I mean, a first time home buyer, if they qualify with their income, only needs to put 5% down, on a $825,000 house. I mean, do you remember when 417,000 was the conventional loan limit? Yes. Forever? Yes. Then it started changing,
It's painful. Yes. I also remember when we refinanced to 6.5, and I was super excited. I thought, and then when we refinanced in the 5s, I was like, oh, so it's all relative, but people are keep asking me, when are prices going to come down? Well, they go up really fast and they come down really slow. So if that's what people are waiting for, the best you can do is where we are currently. And that is, there's not a lot of competition right now, especially for things that people feel are overpriced. Even though there still is all of that demand, buyers will not overpay for something unless it is absolutely turnkey move-in ready, or there's something spectacular about it that they're afraid they won't find in the future. So it really is an interesting time.
Right. I mean, for the people that purchase now that can stomach the rate as temporary, and then, let's say a year from now, rates are in the 6s, and then, more people are coming out and be like, oh, rates are in the 6s. Now we want to buy, right? There's going to be so many more offers. I mean, still today, there's multiple offers on properties that, rates, high 7s or low 8%. So just think how many more people are going to be making an offer on that same house when it's listed, next year. And then, Mortgage Bankers Association, those guys are much smarter than I. They're calling for mid 5s eventually to be the new norm, which it should be. I mean, we don't want interest rates to be like like Bitcoin going up and down like this every day. Even would be great. But, when it comes to the mid 5s, I mean, the buyer pool is going to be much larger.
Correct.
which means more competition, versus when rates get to the mid fives and you already own your home and you just have stepped down on a refinance a few times, you're already where you want to be.
Right. Right. All right. The other thing that we are finding more common is if someone wants to buy, they are not keeping their house as a rental, but they also need to be non-contingent. Now, this time of year and with the current situation, I'm sure there'll be a lot more people that are willing to accept a contingent, but maybe not with how slow things have gotten. So what are some options that people have if they need to sell something first and then purchase, but be non-contingent?
Okay. So this all goes back to, we need to have the conversation early on. Okay. Because this is a plan, and there are a few different strategies that work well with this, but they don't happen overnight. So, I had a client make an offer on Saturday, $1 million price point. They went over by 25. And then there was a contingent offer at 1.1. So we thought we had a pretty good scenario there because we were non-contingent, but we still lost because someone went to $1.05 million non-contingent, right? So being non-contingent is key. I agree with you. There might be some scenarios that a seller says, I'm not in a rush, we'll take the contingent offer. But to go non-contingent means that you don't need to sell your current home to qualify for the new home, right? But you want to sell your home for various reasons. I want the cash out. I don't want to be a landlord. I'm relocating, so I can't actually manage this property in Tennessee and move to, Maryland. So if we do this early on and you can qualify with both payments, I would suggest we get a line of credit set up on your current home right away. And then you can access your equity as a down payment on your new home. And then when you sell your departing home, you pay off your mortgage and your home equity line of credit. Sometimes there's a small penalty for paying off a line of credit that quickly, but it's less expensive than other scenarios. So it's normally worth it. So that's if you can qualify with both payments, meaning your income says, I can own two homes at one time. If for some reason, which is more common than not, that we need to exclude that current mortgage payment and we don't have time to sell your house and we need to go non-contingent, then we do what's called a bridge loan with a guaranteed buy program. And in the last 6 months, we've probably done one a month out of here. And it has really saved the day for people that need the money and that can qualify for both homes. So the bridge loan is another loan. It's like a home equity line of credit, but it's a second lien on your departing home. And the bridge loan doesn't have a payment. This particular bridge loan does not have a monthly payment. And the lender for the bridge loan says, if your home doesn't sell within 6 months, we guarantee that we will buy the house. And when that happens, the lender does not need to include your departing mortgage payment for your new home. This only works for conventional loans. Okay, this does not work for FHA or VA. But frankly, I haven't come across that where a VA buyer, FHA buyer is necessarily looking for this program. So now, it's worked well for conventional.
Is there a limit to the price of the house that they are departing, the departing price of the house?
It is $1 million price point limit for this program. I've only ever had that come up once when they were selling $1 million plus home, needed to go non-contingent, with the sale of their current home. And, they were moving from a waterfront type home to non-waterfront, but needed a larger property. So they're actually buying a less expensive home because they had more kids. So, but that's a fairly unique scenario. But yeah, good question. So the bridge loan will give you the money for your down payment on your new house. It'll give you up to $30,000 to spruce up your departing home. Right? If Jennifer, you're like, we need to get some neutral colors in here and replace the carpet, this will fund that. It'll cover up to 6 months mortgage payments. And if we choose to pay off debt moving into your new home with the proceeds or the equity of the old home, it'll do that as well. So, student loans, car loans, revolving debt, credit cards, if we choose to pay that stuff off before we move in, it'll fund all of that. There is obviously a fee. It's a very short-term loan, so that lender is a separate lender than me. They get your information from me. You basically just sign the documents to say yes, we agree to do this. You still act as their realtor, and I'm pretty sure you can get a home sold within 6 months, right, Jen?
Definitely.
Okay. Yeah. They don't want to be in business buying homes. In the decade that they've been in business, I think that they told me that they've bought 2 or 3 homes ever. They do not want to own a home. They want to lend the money and quickly turn it and lend it to someone else.
Okay, perfect. On that note, going back to paying off debt, are you seeing that people have a lot more debt now than they have? Are they coming to you with a lot more debt?
In the last 3 to 6 months, yes. For sure. I mean, lots of people were able to save some money during the COVID days, right? We were stuck at home and couldn't spend any money. But we're definitely seeing the savings depleting and the credit card balances increasing. So yes, we are certainly seeing some debt that needs to be paid off. And when we hear, on Wednesdays and Thursdays that the Fed raised rates, the Fed doesn't raise mortgage rates. That's set by the bond market, and it's a whole nother conversation. But when the Fed raises rates, that raises your credit card rate, your future car loan, your home equity line of credit. So, your credit card rate's variable, and average is 24% right now. I mean, that is incredible.
All right. So in the mortgage segment, can you rank the offers from strongest to weakest when it comes to presenting an offer and financing?
For sure. So obviously non-contingent, as we've talked about, meaning you don't have to sell your current home, is far better than contingent. A cash offer typically wins. And sometimes people pay cash for a home and then turn around and get a mortgage immediately afterwards, which is called delayed financing. That's a little trick of the trade that we pull out when it's super competitive. It is very important that it has to be the buyer's funds that bought the home. So you can't get a gift from your parent, buy the home in cash, and then immediately get a mortgage. There's what's called a seasoning period, and it's 6 months. So we can't actually start the loan application officially until you own the home. So if you buy the home today, tomorrow we hit the button to make it a real loan application, and then then go through the refinance process with bank statements and pay stubs, et cetera, and then we pull the money out in about 30 days, and now you have your mortgage. So you were a cash buyer to strengthen your offer for the seller. Number 2 is a loan commitment prior to contract. So this is not a pre-approval. This is not a pre-qualification. This is, you actually send me your bank statements, your pay stubs, your driver's license, tax returns if we need it, but we normally don't. Just a few basic things. I send your file into an underwriter, a human being. They underwrite your file and say that you are approved for a mortgage contingent upon a contract, an appraisal, and homeowners insurance. So then we can present that to the seller and say, this client has already gone through underwriting. This is not the loan officer's assessment. This is not a software program's assessment. I recently saw someone that applied online to an internet lender and they got a pre-approval letter. And the internet lender had no idea what was needed for their qualifications, like tax returns, because they were self-employed. So we can actually, and the underwriter's name is on there, and actually present that. But it's really important that Jennifer and I are telling these people and reminding them, because most people don't even know what that means. So that's when we have time. That takes only about 2 days to make that happen. So, it's not overnight, but it happens quickly. Then a pre-approval where the lender and loan officer actually review all your documents and then issue, a lender letter to accompany that. And then it's our job to call and make sure everybody knows that, yes, we actually pulled credit. Yes, we actually reviewed everything. And then I would say the least competitive would be if, we have to turn this around overnight, don't really have a chance to review everything. Borrower gives us their details and then even contingent, we have to sell the house. So that's, again, why talking to us at least a month prior would be best.